Welcome back to Markets Without Spin. I'm Franz. Today we're going to talk about why corporate boards rarely protect investors. In our last episode, we talked about why corporate executives are often misaligned with shareholder interests and how incentives, not mission statements, determine corporate behavior. Today we're building on that theme. We're going to look at the system that's supposed to restrain management, correct excesses, prevent blow-ups, and protect shareholders, the corporate board. And we're going to confront one of the most deeply ingrained myths in modern finance, that boards manage risk and safeguard your capital. They don't. Boards don't manage risk. They manage appearances, and these are two different things. Investors love the idea of a board as a kind of supervisory panel, intelligent guardian sitting above management, evaluating strategy, spotting errors, preventing blow-ups. But look at the history of modern corporate failures, the frauds, the bankruptcies, the unforeseeable collapses, and you'll notice something consistent. The board is always shocked, always uninformed, always blindsided, no matter how blatant the red flags were. The reason isn't complicated. Boards fail in predictable, structural ways. And before we talk theory, I want to share a story from early on in my career, one that shaped how I view corporate governance to this day. This is a personal story. The story of Bonneville Pacific. When I was a young broker, there was a company here in Utah that everyone knew, Bonneville Pacific Corporation. Because it was local, I took it seriously, more seriously than most people my age would have. I attended every shareholder meeting. I read every report they issued. I studied their filings, and I even met the CEO for lunch several times. The company was in the energy business, and at the time, energy was red hot. Their model was cogeneration, capturing the heat lost in electrical generation and using it for something beneficial, innovative, exciting, and important. But what impressed everyone, including me, was the board and the executive team. These weren't lightweight names. The board included prominent politicians and respected community leaders, and some of the key officers had elite academic credentials, including a Harvard MBA. On paper, this was the kind of board you'd want overseeing a high-growth energy company, except there was one problem. The company was a fraud. The cogeneration facilities weren't imaginary, they were real. I actually drove out to one in Colorado to see for myself. It was a gas turbine plant where the waste heat was piped into a greenhouse to keep tomatoes warm in the winter. The technology existed, the facilities existed, the engineering concept even made sense, but the economics didn't. These plants never produced real, sustainable cash profits. What they produced were accounting profits, created by moving facilities back and forth between related entities at higher and higher book values. On paper, it looked like growth and value creation. In reality, it was just financial engineering. Facilities traded back and forth at inflated book values to manufacture performance that didn't exist. The returns were illusory. The substance simply wasn't there. My clients lost money, I lost money. The company collapsed, and the FBI got involved. I was called to testify. What followed later only confirmed how rotten the core really was. Federal prosecutors eventually indicted several Bonneville executives on charges related from securities fraud to bank fraud and mail fraud. Some pleaded guilty, some went to prison, and federal trustees ultimately recovered well over $100 million from insiders, professionals, and related parties. In other words, this wasn't an honest business that stumbled. It was a fundamentally fraudulent enterprise disguised by respected names and an impressive-looking board. Looking back, I don't believe the board lacked intelligence. I believe the board lacked incentives to challenge what it was being told. If you want a more famous example of board failure, look at Enron. Its board included former cabinet members, former university presidents, and some of the most credentialed people in corporate America. And what did they oversee? One of the largest frauds in U.S. history. The board not only missed the red flags, they approved the off-balance sheet structures that hid billions in debt. They signed off on related party transactions with Andrew Fastow, transactions that would get a first-year analyst fired today. It wasn't lack of intelligence, it was lack of independence. Their prestige became a shield for management, and again, not one board member suffered meaningful consequences. If Enron taught us anything, it's that a board full of brilliant resumes can be absolutely worthless when it matters. A board full of prestigious names is not a safeguard, it's camouflage. And because of my own experience, I permanently changed how I evaluate boards. If a board is stuffed with politicians, former public officials, the checkbox DEI mix, or resume-heavy prestige directors, I don't view that as a sign of strength. I view it with suspicion. Prestige is not oversight. Credentials are not due diligence. Famous names do not protect investors. And once you've seen it fail up close, you never forget it. A lot of the problem is as a result of information asymmetry. Boards only know what management tells them. They don't have independent research teams. They don't run their own audits. They don't embed analysts inside divisions. They receive curated slide decks, curated by the same executives being evaluated. It's the equivalent of judging an investment manager solely from their own marketing materials. Every oversight failure starts here. Governance rules talk about independence, but independence on paper means nothing when the CEO influences who gets on the board, the director wants to preserve his or her board fees. Social cohesion matters more than conflict. Dissent is culturally unwelcome. And trust me, boardrooms reward congeniality far more than skepticism. Directors don't want to be the difficult one. They want to be liked, they want to keep their seat, they want to get invited back and on more boards. Good governance dies in that environment. There's another piece no one likes to talk about. Boards are the ones who approve executive compensation, stock options, the restricted stock, the bonuses tied to adjusted numbers, the golden parachutes. And because executives know exactly which directors will be voting on their pay, there's enormous pressure, subtle or otherwise, for boards to go along with whatever package management wants. But it goes deeper than that. Boards also approve their own compensation. It's no different than politicians voting themselves raises, and it creates the same conflict of interests. Many directors receive stock and option grants themselves, tying them to the same short-term initiatives and incentives as management. So the people who are supposed to stand between executives and the shareholders are often participating in the same pay structure that they're supposed to be overseeing. And the trouble is there are no consequences. This might be the most important failure of all. If a surgeon makes a critical mistake, there are consequences. If a pilot misjudges a landing, there are consequences. If a portfolio manager blows up client money, there are consequences. But when boards fail, when they allow fraud, when they rubber stamp reckless acquisitions, when they miss obvious leverage risks, what happens? Nothing. They keep their seats, they keep their pay, and they may move on to another board appointment. Accountability simply doesn't exist in the board ecosystem. and you cannot have effective oversight without consequences. So why does this illusion persist? 3 reasons. The legal framework requires the fiction. Corporate law is built on the assumption that boards fulfill their fiduciary duties. If you acknowledge that they don't, the legal structure cracks. Companies market the image. Proxy statements and the annual reports always highlight polished bios and reassuring committee structures. Governance becomes theater. And the truth is uncomfortable. If boards don't protect shareholders, then the only true margin of safety is the price you pay, not the governance, not the bios, not the committees. Valuation is the only real protection. So what would real oversight on boards require? If boards were designed to actually protect shareholders, they need independent investigative authority, a dedicated analytical staff, full access to operational data, compensation tied to long-term outcomes, mandatory removal after oversight failures, and protections for dissenting directors. But none of that is coming. The incentives just don't support it. Boards aren't designed to challenge management. They're designed to reassure shareholders, and there's a difference. So here's the key takeaways. If boards won't protect you, what should you watch? Number 1, allocation discipline. Actions, not narratives. Number 2, management honesty. How do they behave under pressure? Do they answer questions directly? Balance sheet strength. Bad governance rarely sinks companies by itself. Leverage does. A company with a conservative balance sheet, conservative management, and an honest CEO will outperform a company with a prestigious board and a fragile financial structure every time. So that's today's hard truth. Boards don't protect investors. They create the appearance of oversight, not the reality. Once you understand that, your entire approach to evaluating companies changes. You stop relying on governance structures and start focusing on things that actually matter. Capital allocation discipline, executive honesty, and balance sheet strength. If you're enjoying this series, please make sure you follow, like, or subscribe on your podcast platform of choice. I'm Franz. This is Markets Without Spin. Thanks for listening.